Hello again, this is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Friday, the 4th of September, 2020. It's our Labor Day weekend, Friday Insights edition. I'm excited for you to be here. Thanks for watching. We've got a lot of topics to discuss, so let's get right to topics of the day. So there you have it. We have a jobs number that was a huge blowout. We just added back the U.S. economy for the month of August, just under 1.4 million jobs. So that's either rehiring those displaced workers because of the coronavirus, but it's good positive sign that shows there's underlying strength of the U.S. economy. Keep in mind, the month before we were sitting at a 10.2% jobless rate, right? Unemployment rate. And now we're down to 8.4% at this moment. And that trend is our friend. So it's a very big positive a trend showing that we had a foundation of a strong U.S. economy prior to the pandemic. So I think right now, you take a breather. Market's taking a breather, as I talked about, their sector rotations inside. I discussed this yesterday. If you didn't get yesterday's update and you want to find out what's going on with the equity markets as they're selling off, it started yesterday and they're continuing today. I ask you to go back and watch the Thursday edition, if you will, on my daily update. And I explained the market rotation, what's happening right now. But essentially, we had a great quality blowout number for the unemployment rate. So that's the easy work. The easy work has been done right now. The hard work is from the 8.4% unemployment rate from this point forward. Because let me take you back in history. We look at history a lot as it relates to managing portfolios and equity markets and putting sort of recessions and recoveries into perspective. So if you go back to 2008, 2009, and go all the way forward to 2012. 2012, we had an 8.1% unemployment rate in 2012. You might not remember that, but we did at that time. And it still took them another 4 to 5 years for us to get below to where we are just this last February, below 4% number. So the employment picture from this point forward is going to be very difficult. Okay, the easy work has been done. Now, from this point forward, we need to see, as we know, there's a lot of small businesses, think the service industry, the restaurants have closed, even salons have closed permanently due to this coronavirus pandemic. And it's just tragic. Our local communities, again, for years to come, will be dealing with this. So that's why we need Congress, once again, to deal with the CARES 2.0 Act, extend the unemployment assistance, because that number is very sensitive on the employment number right now. And we could see a tick up in the weeks and months going forward. And keep in mind, this is going to be stubbornly high on the world of unemployment. Why? Because if you're a small business owner, you're going to learn to deal with the efficiencies at hand. One, you don't know if this resurgence of this pandemic or the economy, you don't know what kind of footing you're on if you're a business owner. So you're going to hold on to the employees that came back first, that support you, that have the experience, so on and so forth. But you might not need that extra 1 or 2 employee to get you through sort of the growth phase. Because right now it's about survival. So that extra 8.4%, we could see that number come down in the unemployment rate, but we're going to still see that stubbornly high. Another aspect is the technological revolution, right? There's a lot more efficiencies. Small business owners can basically replace, the 2 people to do 1 person job, but more importantly, give them the technology or have them add some more technology, whether it be, hardware or software, to do the work of 2 or 3 other employees. We're seeing that in every facet of the economy, and that's going to continue to persist. This is a technological revolution. One of the reasons why tech has been leading through this coronavirus pandemic. So that's key to pay attention to and key on. So also today, as we have a sell-off as the market rotation, it's in going into Labor Day weekend or long weekends, if you will. You always want to watch a Thursday, Friday sell-off. So it's the close we watch. So if we accelerate negatively into this weekend's close, that means Tuesday when we reopen, markets could continue the sell-off to Wednesday or Thursday and then catch a bid. But if we see a bid in the midday session and we close with some sort of strength, that's also a positive sign. Think about it. Technology in the last 24, 48 hours has had sort of a 10% correction depending upon the individual stocks or the individual indices that you're looking at. So it's been hard and fast, but a 10% pullback and a breather is not unexpected or uncommon. In fact, it provides opportunities for us in the world of professional money management. So we're taking advantage of that too, and we see opportunities. Finally, Labor Day. Labor Day, everyone have a happy Labor Day. Basically it's honoring those that obviously are employed and working, but those are not employed and working as well, just as equally. This is one of those fluid situations that's going to continue to propel into the new year. But more importantly, it's the election that everyone needs to pay attention to. And I invite you guys to join us in the election edition. It's going to be September 16th. Rob Stein, First Trust, a political strategist. He lives his life in Washington, so he's going to give us some insights as to what to expect if one party or the other happens to sort of get in the White House, and then subsequently what Congress happened, or wherever Congress lies, and ends up. And that means for all of us, ultimately, taxes and regulations and policy changes and a whole lot of things that we have to think about. So please join me for that. Like and subscribe, and thanks for watching, and have a wonderful, relaxing, restful, and safe Labor Day weekend. Till next time, take care.